this one off so we can do that. Thank you, Evan. Yeah. Good afternoon, everyone, and welcome back live to the Peterson Institute for International Economics. We're here today very proudly and excitedly to hear the first speech by the Honorable Dr. Lisa D. Cook as a member of the Board of Governors of the Federal Reserve System. I will try to properly introduce Lisa in a moment, but just to say this is the start of our busy season, as always at the Peterson Institute, heading into the annual meetings of the IMF and World Bank and the G20. And we are all, as always, very fortunate to have a list of both US and foreign officials. And the sequence kicks off today with Governor Cook. We also are taking a little bit of pride today, or pride's the wrong word, let's say satisfaction, that we are, for the first time since COVID, having a meeting with a lunch and with people present, and this puts an extra little spring in our step. And we look forward to continuing to have these hybrid events, reaching, of course, first and foremost, our global audience that tunes into both the live stream and the recorded videos on the Peterson Institute website, but also our friends and neighbors in person who are able to join us on these occasions. In addition to Lisa, Governor Cook, over the next week and a half, we look forward to this afternoon, the presentation of the semi-annual Global Economic Prospects, led by Karen Dinan, and today accompanied in speaking by Olivier Blanchard and Mary Lovely. That will be taking up some of the same themes from an independent and different perspective than Governor Cook. Tomorrow, I am truly excited to announce we'll be doing the launch of the new book by our colleague Martin Chorzempa, The Cashless Revolution, China's Reinvention of Money and the End of America's Domination of Finance and Technology. This is Martin's first book, and it's a barn burner. I think you're going to enjoy it. On Tuesday of next week, our old friend Thomas Jordan, chair of the governing board of the Swiss National Bank, will be here to give the annual John Olkay Lecture on Ethics and Economics, speaking about current challenges to central bank independence, which I think we will all agree is a topic of great moment. On Thursday next week, Catherine Mann, an alum of the Peterson Institute and a member of the Monetary Policy Committee of the Bank of England, will be giving a speech. And on Friday next week, we will be launching the 25th Geneva Report on the World Economy, where many of our friends have co-authored some new work on climate and debt with Beatrice Vader de Moro presenting. And then finally, another sort of PIIE alum, another central banker. On Saturday, October 15th, we will be having Chang-Yong Ri, the new governor of the Bank of Korea, formerly the head of the IMF Asia Department. So this is a very exciting time for us. I hope you'll all either join us or tune in or record later and give us your feedback. But today, my advertising is over and I can turn to the meat of today's meeting, which is the speech by Governor Lisa Cook. I should say that I had the privilege to meet Lisa for the first time now 27 years ago. I was just starting out as an economist at the New York Fed, and Lisa was doing, as usual, 17 different things and decided she, among her other things, wanted to have an internship at the New York Fed, and she was randomly assigned to work with me. I learned a lot more from Lisa, I'm sure, than she learned from me. At the time, she was working on transition economies, and I know she's going to be talking about some of the lessons she learned from that work for today. Lisa took office as a member of the Board of Governors on May 23rd of this year. She's filling an unexpired term that ends January 31st, 2024. Prior to her appointment, she was a professor of economics and international relations at Michigan State University. Importantly, in that role, Lisa, for many years, led the American Economic Association summer camp and mentoring program for underrepresented minorities in the economics profession and did great service to the profession and to the diversification of it, which we still direly need, but we would be much worse off had Lisa and her colleagues not run that program so well. Previously, Lisa had been on the faculty of Harvard University's Kennedy School of Government. She, for a while, was deputy director for Africa research at the Center for International Development there. She had previously been a national fellow at Stanford. For all us Washington folks, people got to know her as well from 2011 to 12 when she was a senior economist on the Council of Economic Advisors under President Barack Obama. She had previously, in 2000 to 2001, served as a senior advisor on finance and development in the U.S. Department of the Treasury. She holds a BA in philosophy from Spelman College. She was a Marshall Scholar, I believe the first Marshall Scholar from Spelman, where she took a BA in philosophy, politics, and economics from Oxford, and later earned a PhD in economics from the University of California at Berkeley. Importantly, Lisa has done research and advocacy, but mostly research on issues of development, on issues particularly of transition economies and policymaking under uncertainty, and as well on some groundbreaking research on the issues of what our society and other societies have lost in terms of foregone innovation and growth because of excluded people, as well as a number of other important studies. I am personally proud and grateful that she went through what she went through to become a full-time public servant again, and I'm proud to welcome Lisa Cook to this stage. Thank you, Lisa.
Thank you, Adam, and thank you to the Peterson Institute for inviting me to speak today. This is my first speech as a Fed governor, and I am delighted to deliver it here, joining friends and colleagues from across my career, from academia to policymaking. I would like to start with a discussion of the U.S. economy, including the implications of international development, then talk about my approach as a policymaker and how I view the stance of monetary policy. I will begin with the labor market, which is very strong. Employment rebounded much more swiftly post-pandemic than it did during previous recoveries and has continued to grow at a rapid pace of about 440,000 jobs a month so far this year. The unemployment rate at 3.7% remains very low. Other indicators also point to labor market strength. Despite a large drop in the number of job openings in August, which may suggest that labor demand is moderating, there's still an unusually high 1.7 job openings per unemployed job seeker. Meanwhile, layoffs are near historic lows, and the quits rate is well above pre-pandemic levels, even as it has moderated somewhat, indicating that workers still feel confident they can find another job. On the supply side, labor force participation has recovered more slowly than expected and has largely moved sideways this year, even after a welcome rise to 62.4% in August. Early retirements prompted by the pandemic have not yet reversed. Some of these are likely due to fear of exposure to COVID. And COVID continues to weigh on a full recovery in labor supply in other ways as well. As people with long-haul cases and caring responsibilities stay home, and others lose hours to short-term illness. If the health impact of COVID-19 continues to diminish, I am optimistic that more workers will re-enter the labor force, but there is a risk that labor supply remains below its pre-pandemic trend. On the price stability side of the Fed's mandate, inflation remains stubbornly and unacceptably high. And data over the past few months show that inflationary pressures remain broad-based. My focus, therefore, is on bringing inflation back down to our 2% target. I am heartened to see measures of medium to long-term inflation expectations falling in the surveys from the New York Fed and the University of Michigan. Although those declines may partly reflect falling gasoline prices, they provide some evidence that inflation expectations are well anchored. The data on actual inflation, however, have shown a slower decline than I had anticipated, and I am seeking to better understand the reasons. I am focused on the lag between signs of easing price pressures and actual inflation coming down from its very high levels. Much of the surge in inflation over the past year was rooted in the incomplete recovery of aggregate supply from pandemic-related shutdowns. Global supply chain disruptions had especially wide-reaching effects. This year, Russia's invasion of Ukraine sparked a surge in energy prices and affected global food markets both directly by reducing shipments of commodities such as grain and indirectly by, for example, curtailing fertilizer production. In recent months, some of the upward pressure from these forces has begun to wane. Supply bottlenecks appear to be easing, and global oil and commodity prices have declined. This largely reflects worsening global growth prospects, notably in Europe, which is suffering from the reduced flow of Russian natural gas, and in China with its zero COVID policy and property sector difficulties. US gasoline prices have fallen more than $1 per gallon since June, reflecting the fall in oil prices and refinery margins and helping to slow the monthly increases in headline consumer prices. However, core prices, those excluding food and energy, have continued to rise rapidly. In particular, inflation in core goods prices has been surprisingly strong. That is in part because the elevated demand for goods we saw during the height of the pandemic has taken longer to abate than previously anticipated. Still, there are reasons to expect core goods inflation to slow in coming months. Wholesale used vehicle prices have declined considerably, but there is some uncertainty about how long it will take for that decline to show up in consumer prices. Similarly, new car prices should moderate over time as production of new vehicles continues to ramp up. Overall, a broad range of goods have seen declines, in supplier delivery times and freight prices. And core import prices have fallen in each of the past 4 months, driven by lower commodity prices and an appreciating dollar. Although supply constraints in goods appear to be easing, we cannot assume that improvement will be steady. Globally, at least one potential snag is the possible reduction in Russian oil supply later this year when European sanctions come into full force. As we saw with drought in Europe and China and the floods in Pakistan, extreme weather conditions may also disrupt global supplies of food and other commodities. Domestically, the recent threat of a rail strike, although averted, highlights the existence of latent risks that could result in further negative supply shocks. Consumer prices continue to rise rapidly over a broad range of services as demand for services recovers. Continued strong wage increases will likely put further upward pressure on service price inflation. Housing services inflation will likely boost overall inflation well into next year. Although rent increases on new leases are starting to slow, that moderation also is likely to have a substantial and uncertain lag before it appears in PCE and CPI measures of inflation. The widespread nature of the inflation pressures suggests that the overall economy is very tight, with constrained supply continuing to fall short of demand. The Fed cannot act directly on supply, but it can moderate demand by tightening monetary policy. The rate hikes so far this year, coupled with expectations of further hikes and ongoing balance sheet runoff, have led to a sharp tightening of U.S. financial conditions. This has helped to soften interest-sensitive components of private demand, including business investment, and most notably, housing. Indications of cooling in the housing market include declines in single-family starts and permits, existing home sales, and home buyer and home builder sentiment. While there is heterogeneity across countries, high inflation is a global phenomenon. And financial conditions have also tightened abroad, as foreign central banks have raised policy rates. Some observers have raised concerns that central banks around the world, which are tightening policy to contain domestic inflation, may not be accounting for the cross-border spillovers of their policies. My role is to focus on the Fed's dual mandate, to promote maximum employment and stable prices for the American people, which is a domestic mandate. My colleagues and I on the FOMC, however, are very attuned to foreign developments, including monetary policy abroad, and their effect on domestic conditions through trade and financial market channels. Sharp slowdowns in foreign economies, along with dollar appreciation, are reducing demand for U.S. exports, and financial market spillovers between the U.S. and abroad are a two-way street. As with almost everything else in these times, there is substantial uncertainty about the size of these spillovers. These international dimensions are among those I consider in my risk management approach, which I will describe in a moment. I will also address how data drive my understanding of the inflation dynamics I have outlined. The role of policymaker robs economists of one of the profession's great joys, which is to simply ruminate or expound on the vagaries of economics. In my new role, I must make judgments on the economy, weighing new information against existing theories and translate those judgments into appropriate policy action. To a large extent, my own research and experiences shape my views on policy. My research on economic growth has given me an appreciation for the dual mandate and the importance of economic and financial stability for fostering innovation and growth. My experience working at the Council of Economic Advisors during the Eurozone crisis and with emerging economies, especially Russia and in some African economies, has taught me how difficult it can be to forecast in highly uncertain environments. I also saw firsthand that it is often a mistake to rely on standard models for non-standard situations. Paying close attention to the data is key. which of course includes readings on inflation and the labor market. But we must be humble about our ability to draw firm conclusions and prepare for inevitable surprises. We also need to consider timely, high-frequency data that more quickly capture evolving economic developments than do traditional data sources. Examples include wholesale used car prices, rental rates on new leases, and survey responses on supplier delivery times or prices paid. There is also non-traditional real-time information, such as Google mobility data and open table data on dining reservations, which were useful in estimating economic activity during various waves of the pandemic. In considering whether standard models remain appropriate, one focus for me is the well-known long and variable lag between monetary policy actions and their effect on the real economy and on inflation. Less of a lag may exist now between rate hikes and the tightening of financial conditions, which occurs as markets anticipate future rate hikes. Residential investment also responds quickly to changes in monetary policy, while consumer spending is slower to react. Lags between monetary policy and inflation are even more unclear. Expectations of future monetary policy can have quite rapid effects on commodity and other import prices, but monetary transmission through economic slack appears to affect inflation more slowly. I believe that uncertain times require a risk management approach to policy setting, looking not just at the expected outcomes, but also considering the most salient risks in setting the policy stance. In the current situation, with risk to inflation forecasts skewed to the upside, I believe policy judgments must be based on whether and when we see inflation actually falling in the data rather than in the forecasts. Although most forecasts see considerable progress on inflation in coming years, it is important to consider whether inflation dynamics may have changed in a persistent way, making our forecasts even more uncertain. How do these experiences and the principles of data dependence and risk management influence my views on current monetary policy? In 2019, well before joining the board, I took part in the Fed Listens event in Chicago. A key takeaway from Fed Listens was the value of sustained, strong labor market, a sustained, strong labor market that brings people off the sidelines, those who have been on the margins, but who have skills that can be developed and the desire to be part of the workforce if given a chance. Just 2 weeks ago, we held another Fed Listens event to hear how businesses, families, and communities are adapting to changes in the post-pandemic economy. Notably, we heard about the burden that lower and middle income families are feeling from high inflation. These events highlighted for me the importance of achieving both our employment and price stability mandates. In our current economy, with a very strong labor market and inflation far above our goal, I believe a risk management approach requires a strong focus on taming inflation. Inflation poses both a near and long-term threat. Aside from the immediate effect of higher prices on households and businesses, the longer it persists and the more people come to expect it, the greater the risks of elevated inflation becoming entrenched. I think it is critical that we prevent an inflationary psychology from taking hold. This is not simply an abstract concept, but a risk I take seriously based on personal experience. My time doing dissertation research in Russia in the mid-1990s taught me how disruptive and painful an extremely high inflation environment can be. Reports over the past few months have shown high inflation to be stubbornly persistent, while the labor market has remained strong. Being data dependent, I've revised up my assessment of the persistence of high inflation. And given my risk management approach, with upside risk to inflation being the most salient, I fully supported the step up in front-loading the policy over the past 3 FOMC meetings. Front-loading has several positive features. It puts monetary restraint into place more quickly to reduce demand while supply is constrained. It may also act to rein in inflation expectations and, as a result, to influence wage and price setting behavior. This preemptive approach is appropriate. Although lowering inflation will bring some pain, a failure to restore price stability would make it much harder and much more painful to restore it in the future. When I first joined the FOMC, our policy rate was still below 1%. In the 3 meetings since, we have moved expeditiously by raising rates 75 basis points at every meeting. As we move forward in these uncertain times, policy should remain focused on restoring price stability, which will also set the foundation for a sustainably strong labor market. With inflation running well above our 2% goal, restoring price stability likely will require ongoing rate hikes and then keeping policy restrictive for some time until we are confident that inflation is firmly on the path toward our 2% goal. At this point, as we continue to tighten monetary policy, it will become appropriate to slow the pace of increases while we assess the effects of our cumulative tightening on the economy and inflation. In any case, the path of policy should depend on how quickly we make progress toward our inflation goal. In sum, inflation is too high, it must come down, and we will keep at it until the job is done. Thank you.
Stage. Thank you very much, Governor Cook. And again, we're very glad you chose the Peterson Institute as the venue for your first speech. You are appropriately, as I know your colleagues on the committee, and I left my question sheet on the table. Yes, that one. Thank you. Thank you, Jessica. No, that's not it either. Okay, we'll figure it out. As you have, you and your colleagues have focused throughout the recent months on stemming high inflation. You mentioned some of the data points and some of the conflicting data points that are out there. What are some of, to you, the key data points to focus on as you try to figure out whether inflation is slowing enough? Or are you simply going to keep going until inflation actually is at target?
That's a good question. So as I was saying in my speech, I am data dependent. I am willing to alter the course as the data evolve. And I embrace a risk management approach that looks at and considers the baseline projections, but also understands the salient risks. So among the various variables that I mentioned in the speech, let's say wholesale prices for vehicles, but also so traditional high frequency data, but also real-time data like Google mobility data and open table data. And we certainly want to be able to observe how monetary policy is having an effect on financial conditions and other outcomes we're interested in, particularly inflation. So we're looking at a broad range of indicators, not just one indicator, and I think that's appropriate in a highly uncertain environment.
As you sort through these multiple indicators, and you've mentioned the risk management approach, which you explained, That's a very big contrast from the calls by some in the markets or in academia for a more rules-based approach. Um, how do you see those complaints about Fed behavior? How do you see reconciling a data-dependent approach, as you and some of your colleagues have spoken about, with this commitment to longer-term credibility?
So as you know better than anyone, the rules versus discretion debate is a long-standing one in macro. But we have to be careful. You know, I'll start by giving an analogy. I use Google Maps to get to the board every day. And, you know, you have to have some situational awareness. The guide, that is Google Maps, is very good, but it tells me to turn left on Constitution every morning. And since I have been here, for the months I've been here, it's been illegal to do that. So you have to have some situational awareness if you are using these rules. And this is something that I learned when I was working with you and working on my dissertation in a highly uncertain environment. You may not know you may not have all of the information you need. The economy may not sit where you actually think it is, but those rules are also data dependent. So I want to be careful in drawing a sharp distinction between just being data dependent and just being rules based.
Thank you. I have been blessed with my questions rather than having to draw them from memory in the wrong order. You just cited your previous work on transition economies and how that prepared you in your comments and your speech to make policy under uncertainty. Could you expand a bit on lessons for the U.S., you know, because the U.S. tends to think we can't learn from anybody, let alone from some transition or developing economy. So what's relevant? And also just, is this period of heightened uncertainty, in your view, something that's going to persist post-COVID? Or is there going to be a reduction, you think, in the kinds of uncertainty you're talking about, so we can go back to a more simple policy making?
Right. So I'll reiterate this, but I'll make it even more specific. Being in an economy, working in an economy like Russia or Nigeria, certainly made me data dependent because you had to be able to alter the course once data presented themselves and to follow this risk management approach. As you know, in emerging markets, there are so many more risks than in advanced economies, and those risks have to be taken into account. And I think this is something that has served me well. That lesson has served me well at the board. My response, based on those two features, has been to raise my expectations with respect to persistent inflation and to vote for, to agree with, support the front loading of rate hikes, also addressing the salient risk that high inflation could become, and you know, I don't want to say vote for it because at least endorse or support higher rate hikes. In terms of uncertainty going forward, the uncertainty I think about the most is COVID in the short run, because if we increase labor force participation, if the COVID risk diminishes and labor force participation increases, that will be a good thing for the economy. We don't know if it will exceed the pre-pandemic trend, but I think that's something to look forward to. But other sources of heightened uncertainty persist through global tensions that will have an effect on the energy supply and on other outcomes on the economy more generally, other outcomes that we're interested in.
Thank you. You've already talked about essentially how you know there will be enough tightening, although no is too strong a word, but how you will judge
right.
there's been enough tightening. Does that mean you think in terms of a terminal rate or a peak rate for monetary policy? Or is that something that you're frequently updating your thinking? I mean, we know that in the SEP, Chair Powell spoke at Jackson Hole in his last press conference about, well, the committee is forecasting such and such an interest rate a year from now or 2 years from now. So if you could just say a little more about how you think about setting a terminal rate, updating a terminal rate, or is that a distraction and the wrong way to think about this?
That's definitely a good question. I think over time, we will learn the appropriate path of the policy rate, including its peak. So that will be the terminal rate by observing how the economy responds to monetary policy tightening, and that's through tightening financial conditions. So thus far on the FOMC, during my time on the FOMC, we've moved quickly to raise rates more quickly than we have in decades. So I think that high inflation that has required this front loading, and it's required to short circuit the potential psychology that can take hold, that can become entrenched related to inflation expectations. So going forward, as I mentioned in my speech, as we continue to assess, to continue to tighten policy, it'll become appropriate to slow the pace of increases and then assess the effects of our cumulative tightening on the outcomes we're interested in, on the economy and on inflation.
Thank you. So far in your remarks and in our conversation, you've been focused on the interest rate instrument. Of course, the Fed has had, at least for the last several years, a balance sheet or quantitative instrument as well. What do you think is the right sequencing or balancing of some form of quantitative tightening along with interest rate rises? Do you worry at all? I mean, you may think the answer is zero, and that's fine, but also to the degree you might want to use quantitative tightening, do you worry at all about illiquidity in the Treasury market like we saw in spring of 2020?
Well, before I arrived at the Fed, the FOMC announced its plan for QT for balance sheet runoff, and this means not fully reinvesting the principal payments from securities that it holds. So I still believe this is the right path, and we will continue to see this acting as a complement to interest rate increases. So we're not just solely focused on interest rate increases. So with respect to your question about the Treasury market, the period we're in now is not like March and April 2020, which was extreme. The Treasury market is functioning well. We've seen volatility increase. We've seen depth that is lower, but we see large volumes of trades being executed. So in that sense, the market continues to function well.
That's reassuring. A last question for me, and then we'll open up to a couple questions from our audience. You were speaking about the labor market and the lessons from the Fed Listens conference in Chicago in summer of 2020, and I was there with you, and that was very much about running the economy hot. Do you think that post-COVID, the NAIRU is higher than it was before? The SEP, the NAIRU projection, long run now is 4.0. Our colleague Olivier Blanchard, for example, has argued that the NAIRU post-COVID for at least a while may be as high as 5.5, I believe was the number he was talking about. You may not want to comment on that specific number, but as you do your risk management, what do you think about the possibility that the NAIRU is higher for possibly a long period?
So that's a good question, and as you know, the NAIRU is the subject of a long-standing debate in economics. And I find Nehru a useful concept, that it also is an abstract concept. Nobody knows exactly where it is, and I don't pretend to have the answer to that. So again, I think we have to be data dependent in this situation. We have to be open to inevitable surprises. And I think anybody who would say that the path of unemployment has been predictable over the last 2 years is not telling the truth. So I think that it's highly uncertain where Nehru is. Again, a useful concept, but I'm not going to say I'm careful about using concepts of Nehru in this environment. Because, for example, we don't know if Nehru is short run, a particular estimate is appropriate, or if that is something that will persist. So I want to be careful about using models and abstract concepts that are valuable as benchmarks, but may not give us sufficient information in a highly uncertain environment.
Thank you. Just to clarify, and I should have said it when I was posing the question to Governor Cook, NARO stands for non-accelerating inflation rate of unemployment. I know all of you who are watching around the world and here today are all Fed macro geeks and know this, but just in case, it's the unemployment rate that one thinks inflation will neither be going up or down, is consistent with that in a fully employment economy. Thank you so much, Governor Cook. Let me open it up to the floor. This is all on the record. We have questions. Maybe I'll start out by asking Steve Kamen.
Thank you. Governor Cook, I very much appreciate your speech, and I think you did a great job, actually, of anticipating my question, which was to ask you about spillovers of Federal Reserve tightening to the rest of the world, and how should the Fed think about that? And so you gave a very nice answer, and that forces me to dig a little bit deeper. Could you talk a little bit about to what extent Federal Reserve tightening has been putting pressure on emerging market economies, and perhaps forcing them to tighten their monetary policies more than they might expect? And under what circumstances could you see enough distress or crisis in emerging market economies leading the Federal Reserve to kind of lighten up on its tightening policies? Thank you.
Thank you, Steve. So I'll just reiterate from my speech, we're very attentive. The FOMC members and I are very attentive to these international spillovers, whether they're to emerging markets or to advanced foreign economies. And as I said, it's a two-way street. What happens around the world affects our global outlook, so we're very attuned to these. But our mandate is domestic. So we're very focused on inflation as it evolves in this country. We have the tools to address domestic inflation, and that's what we are highly focused on. But we're very attentive to what's happening in the rest of the world.
Another question from the floor. Please raise your hand and I'll recognize you. Yes, please. If you identify yourself when you're handed the mic, please. Yep.
Oh, I guess just I want to go a little bit further.
Sorry, could you identify yourself?
Oh, sorry, identify myself. Mark Warner, I'm a local lawyer, I guess, sort of. My question, I guess, for you is just a little bit further from the last question, which is, so when you say you look at international spillovers and you're attentive to them, I guess the question I have is, to some extent, you have inflation that will be driven from outside of the United States. And so to the extent that monetary policy in the United States drives inflation outside of the United States, there's that sort of rebound effect into the United States, if I can put it that way. And so I'm just curious to hear you, to sort of try to get you to go a little bit further to your thinking of how you sort of manifest that attentiveness to those spillover effects. Thanks.
That's a good question. The staff forecast that we are briefed on before every FOMC meeting contains in its models, the models that are summarized for this and for us and the findings from those models include these explicitly, right? So these spillovers explicitly. So it's not that we're thinking and just attentive to, this is embedded in the research that is produced by the Fed staff. So that's the way we are feeding this into our thinking. So it's embedded. Our mandate as policymakers is domestic, but this is embedded in what the staff do.
One last question from the audience, please. Yes, over there, please.
Nick Lardy, Peterson. My question is the following. You and your colleagues rely a great deal on having this 2% target for inflation. Could you give us a little rationale of why 2% is the right number, how it was derived? I know it's been around for quite a while, but why not 2.5 or 1.5 or 5 or something? What if you're wrong about what we should be shooting for?
That is a very good question. And I'll just say, I got here at the end of May. This target preceded me at the FOMC, and this is our target. No, seriously, there certainly have been discussions about whether that's the right target, but for right now, this is our target. And this is our part of our framework. This is our objective, and that's what we're striving to bring inflation down to, in the medium and in the long run.
If you want to know a little more about the history, I got a book I can give you. But with that, thank you to Governor Cook for engaging in the critical issue of the day, which is the Federal Reserve's commitment to and methods of bringing down inflation. And we remain excited for what you will bring to the FOMC's deliberations in the years to come. And we'll look forward to having you back at some point when that's allowed.
Thank you so much, Adam.
Ladies and gentlemen, Governor Lisa Cook. Thanks to everyone who tuned in or joined us in person. Just a reminder that we will be having our Global Economic Prospects event later this afternoon, I believe at 3:15. 3 at 3 p.m. today. Sorry, I'm just off a plane from Singapore. But I remember the substance. We will have Karen Dinan talking about the U.S. outlook and the global outlook, Olivier Blanchard on European outlook and inflation, and Mary Lovely about the economic prospects for China. So please join us then. Thank you.